All right, I just got done with my political most important video you will see for politics this month, uh, January 2021. This is the one for stocks. So right now, what's going on is there's a lot of meta that many traders or new traders, even older traders, aren't aware of, and that's the most important thing in stocks is the meta. Like all things, I myself am really into game theory, and game theory everything that people do because of the way that we're wired is related to that. Like you're trying to do things for reasons and you want to do them the best you can if it's important to you. And that's what a game is in essence, you know. So that's why I'm evaluating it that way, and that's why it's the most important thing. And so, in terms of uh, the current the current events and the current meta, the meta is not to play the underlying equity or the underlying asset value like has been in the past with Warren Buffett, and that's a good way to do it. Warren Buffett's successful. He buys the stock. He opens up the portfolio. He reads, oh, they've got these assets. Oh, the price is this. Financially, this is a win. So I'm going to buy X amount and hold it forever, and then sell it, before I die, and then I will be, profitable. I mean, that's probably like a lot of just general rhetoric, right? But in terms of what he does, he's looking at the value and he's comparing fundamentals, and that was a meta that lasted a long time, and it still works in some cases, the majority of cases. But the actual meta today is to play the position. The stock market is like a big poker game, and there are different entities. There are people like you and me who are trading stocks. There are institutions that are trading stocks. There are institutions that represent people that are trading stocks, mutual funds, different formats of these. There are different kinds of stocks. There are ETF notes. There are ETF notes that are indexes. There are ones that have like extreme decay, ones that have less decay. And there's these complex algorithms that you can use to trade with. There are people who are using algorithms. There are companies that are using algorithms. There are algorithms that just analyze algorithms. So like the automation end, like I'm not going to really get into that a whole bunch. The how fast they trade and what they do, that would be like a whole other thing to discuss. But the most important thing isn't that algorithms are doing this; it's that the meta is looking at who is playing the stock and in what way. If a lot of people buy calls on a stock, it's beneficial for the people who own the shares to then sell calls and to sell shares in a way that they can still cover themselves in the event that it goes the opposite direction, but they also can lower the price themselves. So if you have enough money, you can just control the price. And since no one company can do this, we have a lot of illegal tacit collusion, right? Antitrust violations. Now, some of this is like, you know, truly tacit. It's truly, you know, like sometimes they call each other on the phone and they're just like, "Hey, we're going to do this." And people have been arrested for doing that. Sometimes they just see what the other company is doing, and I'm not saying they listen to them, because Goldman Sachs will all the time say, "Hey, AMD is not really that good right now." And then you see later, "Hey, when they were saying that, Goldman Sachs bought X amount of AMD." And I use that example because that's a real life example from when AMD was $13 and it moved up to $17. And so, and then I don't mean that anything against Goldman Sachs. Obviously, it's a big company and there's a lot of people. So the other side of that is like, is Goldman Sachs evil? Obviously, there's two biases there. You can say they're good, you can say they're bad, you can say that the person said this because they're in this role and they have a position that is X or Y, and whatever. But the point isn't whether Goldman Sachs is evil or good, but it's that their best play is to say one thing and to do another. That's the best play because they're trying to collect money from traders. They're not collecting money from the value of the stock. You know what I mean? Like they're playing the people. They're not playing the value of the underlying asset. So what happened with GameStop recently is that it's a brick and mortar company. We're having a pandemic, and brick and mortar was kind of on the way out before. They were going to file bankruptcy. All these other things are going bad for them. Their sales numbers are down. if they're having staffing issues, whatever, numerous things plague small businesses during a pandemic also are happening. And they're competing with companies like Steam and other online companies, so like their competition's really stiff, and so their stock's going down. They're making less profit. They've got lower revenues. Their stock's going down. So then these companies begin short selling them. So is short selling playing the people or the stock? Well, to a certain extent, it's playing the people, because if short selling weren't a thing, the people who are buying stocks are going to be people who want that company to do better, right? Because it's an investment. You're investing in that company. You're putting your money into those shares as an investment. Hey, Sierra, uh, what's up? I'll probably talk to you later. I'm just gonna like keep doing my video and just keep going. But anyway, so with GameStop particularly, uh, if you couldn't short sell it, you would only play the asset, right? You would only invest in it because you wanted that company to do better, and you would be picking it out of these other companies because you had a vested interest yourself in GameStop, or because you believed in its ability to return those things. Cool. And then, uh, and then because you can short sell, you basically don't care about any of those people, right? You're an institution or you're a person, and you're like, hey, that company is doing badly. I'm going to let someone use my money while that value goes down and reserve the ability to sell at that price because I want to make money on that difference, right? So then the stock goes down and you make your money, right? And so like actual short selling involves borrowing money to like reserve price, right? So it's a pretty complex thing that I'm not really going to do a good job of explaining, but basically they want the stock to go down because they want to collect money from people who would like it to go up. Okay, and so whether that's good or bad, however you feel about it, obviously there's biases on both sides. If you're making money one way or the other way, like you're going to feel two different ways about it, or you're going to advertise that you're feeling two ways about it, and you're just going to keep your real thoughts to yourself because you want to make your best move and push that profitable ideology out there, right? So like there's two ways that can go, right? One's like disingenuous intellectually, one is intellectually genuous. Is it genuous? Anyways, you get what I'm saying. So enter. Let's bring in the Wall Street Bets reaction to that. They look at the company. They're like, "Hey, we're really smart traders." Uh, they refer to themselves as autists, which is horrible at its whole self. But they look at this, and they're not looking at the value of GameStop. They're looking at the meta that I've been talking about since the start of this video. These companies have short sold it to 150%, a ridiculous amount of short sell. Now, one of the things that happens when someone has this short sell position is that they become very vulnerable to it going up. And their only way to react to that is by buying more shares to cover themselves more for going up. Because at 150%, it's unlikely that they had covered themselves. It's just so expected that they have naked positions. And it's a known factor, right? And so this position they're in has caused a state where basically people are going to buy the stock, and then the people who are in the short sell position have to then buy it to cover that, which then drives it up farther. And because it's an infinite loss situation, uh, it just kind of builds on itself until someone loses to the point that they can't spend anymore, and they're bankrupt. And so GameStop, is just like an air balloon, like a balloon. You let your balloon go at the fair. The air pressure is thinner as it goes higher, which causes the air pressure inside the balloon to expand, which causes it to weigh less, which causes it to rise higher, which causes it to expand, which causes it to go up because the air pressure keeps getting thinner as you go higher, and until it either pops or develops a leak and then like floats down. Like one of these two things is going to happen. And so that's kind of what happened to that stock. Is it just kind of is building up, to $350 from $3, so it's kind of ridiculous. And so that started to happen on AMC. and it started to happen on Nokia and a few of these others because this new meta strategy has really actually accelerated the amount of pay to people who have captured it. So these banks have been caught with their pants down doing really dirty stuff. Like it's just, I mean, that's an opinion. Obviously, I'm using language because I have this bias that I don't think much of the banks doing these short sell. I think that 150% short sell is ethically wrong, and I think that they should have known better not to have positions that are naked. They should have, it's called naked because you're unprotected, right? Like you have no cover. They call it cover when you are protected. Like you've got an investment in a stock in a way that if it goes down, you make money, but if it goes up, you have limited your risk. Now, the way that they did this, they didn't really adequately limit their risk, and that's why the position is doing this balloon routine, which I think I'm beating to the death like a dead horse without fully explaining it because I don't want to like. My goal isn't to try to get into the mathematics of it. My goal is to just explain that there is this meta where you're not playing the stock, you're playing the people or entities that are playing the stock or the people or entities of that are trading that stock. And that's the meta. That's how stocks are or equities are being exchanged right now. And so that's that case. Like that's what was going on. And now the new move is that these tacit colluding banks and entities have decided to restrict traders' access to trade these stocks. So today, if you had Robinhood as your broker, you couldn't buy GameStop stock because they had made it. You could only sell it because and so whenever someone does something really awful like that, I say awful, and I'm going to explain why in a second. Well, actually, I don't even think I have to, right? Like, you can only sell, you can't buy. Obviously, on its face, that's wrong. I don't know if I need to explain that, but I would think I hope I don't. Uh, I mean, basically, you can only leave a position. You can't go back into it. So like, it's causing the stock to crash. It's definitive stock manipulation. So they're saying, because this is their cover story, basically, that the Robinhood traders were manipulating that stock. Well, that they're just playing their best hand, right? In my opinion, I'm biased toward them, so I say they're playing their best hand. If I want to be, intellectually honest, I would say that yeah, sure, the bank has an argument that they're being taken advantage of in the manner that they're in that position and they can't get out really, and there's nothing they can do about this loss. Well, the onus is on them in my mind because they knew that before they got in that position. These are professionals. They had to take a test to do their trading. They had to acknowledge that they knew that risk existed. Okay? They had to pass actual tests and get licensed to do that trading at that level with that much money that isn't even their money, right? Like it's other people's money, right? So, anyways. And and there's a whole nother element to this, right? These are banks. That means that people who have money in these banks are exposed to a certain amount of risk, right? Now, the FDIC will protect like really poor people. If you have $100,000 in a bank in the US, you are federally insured up to that $100,000 mark. If you have more than $100,000 in that bank, you are not necessarily insured or protected, right? So, in a lot of cases, people will just have like multiple bank accounts or multiple banks, or they'll do something like a credit union, or there's different ways to protect yourself. But I don't want to get caught up in like how to do your banking properly as much as that there is a consequence to people because these banks are exposed to this risk. So there's a lot of victims uh, in this situation that makes it more of a gray thing instead of a definitive, you know, fix. But it all comes down to the symptom that they were allowed to short sell it so much without any cover or anything like that. So the risk that they were able to take while putting their customers at risk, So it's anyways. And so that's the important part of this video is that this month this has kind of come to a head. These situations where there's this meta where you're playing not the asset but the people. That it's become such a well-known poker game that's where we're at. I want to bring in a little bit of politics into it because it's interesting to see like AOC, Ted Cruz, they're bickering back and forth, but on top of that, they're also saying, "Yeah, we agree with each other that this is wrong and we need to address this." Uh, and then so politically, it's unifying, which is it's one of the few things that I think that across the aisle everybody can agree. Hey, you can't just stop everybody from trading something because your bank or your backer wants you to. Citadel is a banking entity, if you will, that makes that Robinhood makes money off of. Like they're their customer. Robinhood is a free trading platform. There are people who pay for certain features, Robinhood Gold, if you will. But a large amount of the money that they make comes from selling information about how people are trading, who's trading, and what's going on, like these kinds of things. I don't know exactly what the details are. I think it's written out in the TOS. That's not really important to me as much as like Robinhood is doing this shitty thing to us. They're being paid to do this shitty thing to us, right? The people who pay them have this bias, and so therefore Robinhood has this bias, and so they're kind of puppeting because they're being puppeted. Okay. And then the next thing that I want to talk about is the punishment, right? In situations like these in the past, sometimes, like Citibank particularly, the bank will do a bad thing, and the bank as an entity will be fined. The bank will be punished. The bank's not a real thing. It's 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 an entity that is manufactured or made up, right? Like, yeah, financially it exists, but if it goes bankrupt, the performance that it did, that it got penalized and bankrupted for, has not been treated because that entity is gone doesn't mean that it's been eliminated. People do things, people can be punished. So when they go to punish this, they need to arrest people. The accountability has to be on people, CEOs, chair people, you know, uh, any executives that kind of like made this decision. You know, it's in it, and it's kind of hard, right? Like this is a gray area too because you can say, well, they're just making their best move, or you can say like, if they don't do that and everybody else is doing that, you know, and so there's these other gray areas of justification, but at the same time, it's already on the books. Tacit collusion is illegal. So the act of Citadel making Robinhood do this thing or influencing them to is in itself an illegal thing. Uh, and then there's also elements of like precedence, like have they ever been punished for that before, and what's the likelihood they were going to get caught, right? So like the reason people don't commit crimes usually is because of their internal beliefs, their internal values. Uh, but the reason why we have punishment is for a deterrent. And so that deterrent only works if people believe that they will get caught. Okay? If people don't believe that they will get caught, or if they think that the risk is so small that then they'll do that bad thing. And so that's the other element of the punishment. Like, so I think we talked about what the meta is for stocks. I think we talked about what kind of punishment and who needs to be punished. You can't punish companies; you got to punish people. We talked about what's going on with the Wall Street Bets, WSB's Wall Street Bets, a group of people from Reddit, and how they have kind of seized the situation where the banks are overextended on certain positions. I think one of the things we didn't talk about is how banks take advantage of people. If a company, let's say, I'm personally invested in VVPR right now. It's an EV company who recently closed a deal for 250 million, 250 billion, 250 million. It makes a big difference, and I'm trying to think which way it is. I think it's 250 million. I think they're a small company. It's 250 million, yeah. Well, it seems like such a small company, small number. But anyways, 250 million. They sold a contract for 250 million. Their market cap is 250 million. Market cap is like the price of the shares times the number of shares available out there. Okay. And so if their revenue is going to be 250 million, generally your stock value, if you just look at just fundamentals, the value from fundamentals is that you can make that 5 years to 10 years out there, right? That if you're going to buy that company, you want to receive a return on your investment within 5 to 10 years. If it's a big enough company, you don't mind it taking 10 years because you're going to make billions of dollars. Okay. And so uh, that's also going to feed into my next video, which is going to be the most important video about making money, about how much money people should make, about socialism, capitalism, and these implications. And there's going to be a lot of bias to discuss in that as well. And there's going to be, it's going to have both sides. But basically, for the uses of this video and how important it is, um, the the way that banks are taking advantage of people is that if people buy options to buy stock, right? So you pay a certain amount of money to reserve a price to sell or buy at. So if the stock goes up, you can still buy it at that cheap price. Then you make that difference in profit when you exchange it for the stock, and then you can then sell the stock and get the money out of it because that's how you turn an investment into a liquid asset, money, right? So because you still have value, right? Like if you just trade stocks, like if I had a stock and you had a stock, we could trade stocks if I thought that my stock was going to go up and you had a more valuable at the time stock. But anyways, that's getting pretty complex, right? The point is that people will reserve these prices to buy or sell at. And when banks, I think I covered this in the beginning of the video, but I didn't explain it as thorough as I'm about to. Banks will then manipulate the price of that stock to, not just banks, anyone, anyone who buys and sells the options and and holds enough of the underlying shares will try to influence that in a way to make a profit. So if it starts going up and they've sold a bunch of calls, they're going to have to make money somehow. Maybe they're going to sell more puts, or maybe they're going to sell more shares so that the value goes down, or they'll buy more shares to compensate and then sell higher calls to make up the difference. But they're going to do something mechanically, uh, well, not mechanically, but they're going to do something financially to the way that they're trading to compensate for that loss and to restrict it. And when you are a poor person, you are not going to make up the difference because you can't physically own enough shares to impact it the same way. I'm going to talk about ATVI for a second. Activision stock, 90% owned by institutions. Yeah, if you're a person and you're trading that, you're probably not going to make a big influence because 90% of the stocks available stock for Activision is owned by institutions. So, and there are a lot of other factors that I didn't really discuss in this video just because at this current point in time that's not as important. But I think because I am going to make this video and someone's probably gotten this far, they if you want a little bit more information, outside factors like the behavior of companies can sometimes impact stocks, which is a glorious thing, kind of, I think, in my mind, because then there's like a moral incentive. And so you have these companies that will do these things like they'll buy land and they'll turn it into a wetland, right? Because they want that good PR to bring their stock up, So they do these profitable things altruistically anyways. So it's kind of an interesting thing. Now, whether they should do that or not, whole different discussion, right? Because one bias, one way is going to say like, well, they shouldn't do that because you really want the company to be as efficient as possible because they owe it to their investors, right? And then you can say another way that they should always do that because we're all part of the same world, right? So therefore, do the best thing you can, regardless of cost. So I think this has gotten a little long, and I really want to get to that next video about how much money people should make, really. So I'm gonna go there.